Let's start with the thing nobody wants to say out loud at a dinner party. The economic environment you are about to navigate is one of the most genuinely complicated, genuinely uncertain, and genuinely consequential financial landscapes that most living people have ever encountered. Not in the dramatic, end-of-the-world sense that gets clicks and sells newsletters. In the specific, mechanistic, this is actually what is happening sense that requires honest analysis rather than either catastrophist panic or comfortable dismissal. Here's what makes this moment unusual. We are not facing one significant economic risk. We are facing 5 or 6 of them simultaneously, and they are interacting with each other in ways that make the aggregate situation considerably more complex than any individual risk would be in isolation. Wars that directly threaten the commodity supply chains that the global economy runs on. Interest rates that are high enough to be genuinely painful for every household and every government that borrowed heavily during a decade of near-zero rates. Inflation that has declined from its peak but has proven stickier than the central banks predicted and more persistent than the markets priced. A geopolitical order that is reorganizing along fracture lines that haven't been this visible since the Cold War. A technology transition, artificial intelligence, that is genuinely transformative and genuinely disruptive in ways that the people most affected by it are least prepared for. And a fiscal situation in the world's largest economy that is unsustainable on its current trajectory in ways that everyone can see and that nobody in a position to address it has shown the political will to do so. Any one of these factors would be worth a dedicated video, all of them together, operating simultaneously, interacting with each other, and landing in an economic environment that is already fragile from the stresses of the previous 5 years. That is the situation you are in right now and the situation you will be navigating for the foreseeable future. This video is not a prediction. Let's be absolutely clear about that from the first minute. Nobody, not the economists with the most sophisticated models, not the central bankers with access to the most comprehensive data, not the geopolitical analysts with the deepest network of sources, can tell you with confidence what the economy is going to do in the next 12 to 24 months. The complexity is genuine, the uncertainty is genuine, and anyone selling you confident predictions about the specific timing and magnitude of what comes next is selling you something other than honest analysis. What this video is, a specific, honest, comprehensive assessment of the risks that are currently present in the economic landscape, the mechanisms through which they could translate into significant economic disruption, the historical precedents that provide context for each risk, and, most importantly, the specific, practical, actionable steps that a financially aware individual can take right now to position themselves for a range of outcomes rather than being positioned optimally for only one. Because here's the thing about economic disruption. The people who are destroyed by it are almost never the people who saw it coming and prepared badly. They are almost always the people who were too comfortable, too invested in the continuation of current conditions, or too overwhelmed by the complexity to take the specific precautionary steps that would have made the disruption survivable, and even, for the specifically prepared, an opportunity. You came to this video presumably because you've noticed that something feels wrong, that the economic reassurances don't quite match the economic reality you're experiencing. That the distance between what the official narrative says is happening and what your monthly budget tells you is happening has been growing. That the news out of the Middle East, out of Eastern Europe, out of Washington's fiscal debates feels less like background noise and more like something that might actually matter to your financial life. Your instinct is not wrong. Let's talk about why. Chapter 1. The Middle East Powder Keg: How Iran Could Break the Global Economy. Here's the geopolitical risk that has the most direct, most immediate, and most mechanically specific connection to the global economy, and the one that is most consistently underpriced in financial markets relative to the actual probability distribution of outcomes: the Iran situation. Let's be specific about what the Iran situation actually is, because it is significantly more dangerous and significantly more proximate to economic catastrophe than the comfortable market pricing of it suggests. The nuclear timeline, the risk that changes everything. Iran's nuclear program has advanced to a point that independent assessors, the International Atomic Energy Agency, intelligence agencies across multiple governments, and independent nuclear weapons analysts consistently describe as closer to weapons capability than at any previous point in the program's history. Iran has accumulated sufficient enriched uranium to produce multiple nuclear weapons. The primary constraint on weaponization is no longer material. It is the engineering and political decision to cross the final threshold. The specific economic relevance of this timeline, if Iran crosses the nuclear threshold, or if credible intelligence indicates it is about to, the Israeli government has been explicit and consistent across multiple administrations about its response. Israel will not accept a nuclear-armed Iran. The preemptive military strikes that this position implies would produce a regional escalation that directly threatens the specific economic choke point that makes the Middle East the most economically consequential conflict zone on the planet. That choke point is the Strait of Hormuz. The Strait of Hormuz, the choke point that holds the global economy hostage. Here is the specific geographic feature that makes Middle Eastern conflict so economically significant for every person on the planet, regardless of where they live, and regardless of any direct exposure to the region. The Strait of Hormuz is the narrow waterway through which approximately 20% of global oil supply and nearly 30% of global liquefied natural gas trade passes every single day. The strait is approximately 21 miles wide at its narrowest navigable point. It is bordered by Iran on the north. Iran has the specific naval and missile capability to significantly disrupt or effectively close the strait through anti-ship missiles, naval mines, small boat swarm tactics, and the specific geography that places Iran's coastline along the entire northern edge of the passage. Iran has explicitly threatened strait closure on multiple occasions during periods of elevated tension. It is not a hypothetical capability or a hypothetical threat. It is a documented option that Iran has exercised partially in previous confrontations and has stated its willingness to exercise more completely in future ones. The economic consequence of strait closure, even partial, even temporary, would be immediate, global, and severe. The oil price models that simulate strait disruption scenarios consistently produce estimates in the range of $50 to $150 per barrel above current prices for a sustained closure. At the lower end of this range, $50 above current prices represents a shock to the global economy that exceeds the 1973 oil embargo in absolute terms. At the higher end, it represents an economic disruption of a magnitude that has no modern precedent outside of wartime economies. The inflation implications of an oil price spike of this magnitude. Energy is embedded in the cost of producing and delivering virtually everything the modern economy produces. Transportation costs, manufacturing costs, agricultural costs, fertilizer is petroleum-derived and machinery runs on diesel. The energy price spike from a strait disruption would produce an inflationary wave through the global economy that central banks, already struggling to bring current inflation to target, would be essentially powerless to address through conventional monetary policy because raising interest rates does not produce more oil. The Houthi escalation, the warning shot, the market has already absorbed. Here's the specific development that provides the closest available preview of the strait disruption scenario. The Houthi attacks on Red Sea shipping that began in late 2023 and that have produced a sustained, significant disruption to global trade routes that the market has largely absorbed without fully pricing its implications. The Houthi attacks on commercial shipping in the Red Sea, which are conducted with Iranian-supplied weapons and Iranian intelligence support, have forced the rerouting of significant global shipping traffic around the Cape of Good Hope, adding 2 to 3 weeks to shipping times between Asia and Europe, and dramatically increasing shipping costs and insurance premiums. The shipping rate index for container freight spiked dramatically in response to the attacks and has remained elevated relative to the pre-attack baseline. The economic lesson from the Houthi disruption, a relatively small actor using Iranian-supplied weapons in a secondary shipping lane, not the Strait of Hormuz but the Red Sea, which handles less than half of the strait's commercial traffic, has produced meaningful global economic disruption that persists months after the attacks began. The Strait of Hormuz scenario, where Iran itself, with its full military capability, disrupts the primary oil shipping lane, would produce a disruption several times larger, in both scale and duration. The market has largely absorbed the Houthi disruption without treating it as a harbinger of the strait scenario. This is the specific mispricing that makes the Middle East risk the most consequential, underappreciated economic risk currently present in global markets. The Israel-Iran direct conflict, the escalation ladder that has already started climbing. Here's the specific escalation dynamic that has already moved beyond the proxy warfare phase that characterized the previous decade of Israel-Iran confrontation, the direct exchange of missile and drone attacks between Israeli and Iranian territory that occurred in 2024, and that represents a qualitative shift in the conflict's character. Prior to 2024, the Israel-Iran conflict operated almost entirely through proxies: Hezbollah in Lebanon, Hamas in Gaza, the Houthis in Yemen, militia groups in Iraq and Syria. Each party maintained a degree of plausible deniability about its direct role in escalatory incidents. The specific restraint was maintained because each party understood that direct confrontation escalated the conflict to a level where the outcomes became genuinely unpredictable. That restraint has been partially broken. Iran launched direct ballistic missile and drone attacks on Israeli territory. Israel responded with strikes on Iranian territory. The exchange was managed to avoid the full-scale war that neither party currently wants, but the precedent of direct state-on-state missile exchange has been established, and the specific escalation ladder that the exchange represents has moved significantly higher than at any previous point in the conflict's history. The economic implication of this escalation trajectory. The scenario where a future incident, a more damaging Israeli strike on Iranian nuclear facilities, an Iranian missile attack that produces significant Israeli civilian casualties, a decision by Iran's leadership that the nuclear threshold is worth crossing regardless of the regional consequences, produces a military exchange that neither party intended to be large but that escalates beyond their ability to manage, is meaningfully more probable today than it was 2 years ago. And that scenario is the specific pathway to the Strait of Hormuz disruption that the economic analysis above describes. The oil price scenario analysis. What different outcomes mean for your wallet? Here's the specific scenario analysis that converts the geopolitical description above into the personal financial impact that should inform your preparation decisions. Scenario 1. Continued status quo management. No major escalation. Oil prices remain in the current range. Shipping disruption from Houthi attacks continues but doesn't dramatically worsen. Economic impact. A modest inflationary headwind from shipping costs. Continued defense spending increase across NATO and regional powers. Modest energy price elevation. This scenario the market is currently pricing as the base case. It is not a comfortable scenario. It is an expensive, elevated risk scenario, but it is manageable without major economic disruption. Scenario 2. Significant escalation involving Iranian nuclear facilities. Israeli strikes on Iranian nuclear infrastructure produce Iranian retaliation against Gulf shipping, Strait of Hormuz partial disruption for 2 to 4 weeks. Oil price spike of $40 to $70 per barrel above current levels. Global inflationary shock, significant recession risk in energy importing economies, potential central bank policy paralysis. This scenario the market is pricing as low probability. Independent risk assessors place the probability significantly higher. Scenario 3, full Strait of Hormuz closure of 1 month or longer, oil at $150 to $200 per barrel, global energy crisis comparable to or exceeding the 1970s oil shocks, severe global recession, political instability in energy-dependent economies, potential currency crises in emerging markets dependent on energy imports. This is the tail risk scenario. It is low probability. Its economic consequences would be severe enough that even a 5% to 10% probability warrants meaningful portfolio preparation. The specific preparation this scenario analysis implies will be developed in the later chapters of this video. The foundational point of this chapter is that the Middle Eastern risk is not a background noise geopolitical concern. It is a specific, mechanistically connected economic risk with a specific transmission channel to your energy costs, your inflation experience, your investment portfolio, and the overall health of the economy you are navigating. Chapter 2. The Debt Supercycle. Why the world's financial plumbing is under unprecedented stress. Here's the risk that is least visible in daily life and most significant in structural terms: the specific accumulation of debt across governments, corporations, and households that has reached levels that are in aggregate, unprecedented in peacetime economic history, and that is interacting with the interest rate environment in ways that are producing stress throughout the financial system. The debt supercycle is not a new phenomenon. It has been building for approximately 4 decades, accelerated dramatically during the 2008 financial crisis response, accelerated again during the COVID-19 pandemic response, and has now reached the specific moment where the interaction between the debt level and the interest rate required to control inflation is producing the financial physics of an object whose structural integrity is being tested by forces it was not designed to withstand. The United States fiscal situation, the largest economy's most visible problem. Here's the most important economic data point that most people who follow economic news have encountered but whose implications have not been fully absorbed. The United States federal government is currently running an annual deficit of approximately $1.8 trillion to $2 trillion, approximately 6% to 7% of GDP, at a point in the economic cycle where unemployment is near historically low levels and the economy is not in recession. This is profoundly unusual. Deficits of this magnitude have historically been associated with wartime financing, deep recessions, or financial crises, periods when emergency spending was required to prevent economic collapse. Running a deficit of this scale during a period of near full employment in the absence of any declared emergency means that the structural gap between government revenue and government spending has grown so large that it produces massive deficits even in favorable economic conditions. The mathematical trajectory of this situation is not difficult to calculate. The national debt currently exceeds $34 trillion. The annual interest expense on that debt has crossed $1 trillion, more than the entire defense budget, and is growing because the low-rate debt accumulated during the 2000s is maturing and being refinanced at the current, significantly higher rates. The Congressional Budget Office's projections, which have historically underestimated deficit growth, show the debt continuing to increase as a percentage of GDP for the foreseeable future without significant policy changes that have shown no sign of materializing. The specific economic risk of this trajectory, at some point, the timing of which is genuinely uncertain but the direction of which is not, the market's willingness to finance U.S. government debt at current interest rates will be tested. The specific scenario that has produced fiscal crises in smaller economies, the bond market strike, where investors demand significantly higher interest rates as compensation for the perceived fiscal risk, has not yet arrived for the United States because of the dollar's reserve currency status. But the reserve currency status is not unlimited protection, and the fiscal trajectory is eroding its foundations in ways that are visible to the sophisticated fixed-income investors who manage the largest pools of capital on the planet. The corporate debt wall, the refinancing crisis, that's already beginning. Here's the specific corporate financial stress that is more immediate, more mechanistically specific, and more directly connected to the near-term economic outlook than the government debt problem. The corporate debt refinancing wall that accumulated during the near-zero interest rate environment of 2010 to 2022, and that is now coming due at interest rates that are dramatically higher than the rates at which the debt was originally issued. American corporations borrowed approximately $12 trillion during the low-rate era, issuing bonds at rates of 2% to 4% that reflected the interest rate environment of the time. Those bonds have maturity dates, and those maturity dates are now arriving. The specific wall of corporate debt maturing between 2024 and 2028 is estimated at $3 trillion to $4 trillion that must be refinanced at current rates of 6% to 9% rather than the original 2% to 4%. The cash flow mathematics of this refinancing, a company that borrowed $500 million at 3% was paying $15 million per year in interest. Refinancing that debt at 7% produces $35 million per year in interest, a $20 million annual cash flow reduction from a single refinancing event. For companies with tight margins, significant debt loads, and limited pricing power to pass through the higher cost to customers, this refinancing pressure is producing specific and visible financial stress that ranges from earnings compression to credit rating downgrades to, in the cases of the most leveraged borrowers, financial distress. The specific sectors most exposed to corporate refinancing stress: commercial real estate, where the combination of higher rates and structural decline in office demand has produced a genuine crisis that is still in its early stages; retail, where already thin margins and heavy debt loads from leveraged buyout activity in the 2000s make refinancing at higher rates genuinely threatening to viability; media and telecommunications, which accumulated enormous debt loads during the streaming wars and content acquisition frenzy of the low-rate era; and the private equity portfolio companies, the thousands of businesses owned by private equity firms that were acquired with heavy debt financing at low rates and that must now be refinanced at rates that may exceed the business's actual earnings capacity. The consumer debt pressure, the household balance sheet under stress. Here's the third layer of the debt supercycle that is most directly connected to the daily financial experience of most people: the specific accumulation of consumer debt at high interest rates that is producing the financial stress in American households, that is simultaneously obscured by strong employment data and visible in every consumer sentiment survey and every retail sales trend. Credit card debt in the United States has exceeded $1.1 trillion, the first time it has crossed that threshold. The average interest rate on outstanding credit card balances is approximately 21% to 22%. The highest in the modern data series. The combination of the balance level and the interest rate is producing an annual interest burden on consumer credit card debt of approximately $230 billion, money that is flowing from household budgets to financial institution income statements rather than into consumption that would support economic growth or savings that would support financial resilience. Auto loan delinquencies have reached the highest levels since the 2008 financial crisis. Student loan debt, which was effectively in forbearance during the COVID period, has returned to repayment status for approximately 40 million borrowers, adding a collective monthly payment obligation of tens of billions of dollars to household budgets that were already stressed by the inflation of 2021 to 2023. The specific economic risk of consumer financial stress. Consumer spending accounts for approximately 70% of U.S. GDP. The household balance sheet that is under debt service pressure reduces discretionary spending, the restaurants, the retail purchases, the entertainment, that supports corporate revenue and employment across the service sector. The consumer-led economic slowdown that produces the most gradual and most difficult to reverse recessions is the specific scenario that consumer financial stress produces when it accumulates to the level that the current debt service burden represents. The interest rate trap. Why there's no easy exit. Here's the specific policy problem that makes the debt supercycle risk so difficult to address through conventional economic policy. The interest rate trap that has caught every major central bank simultaneously. The interest rates required to control the inflation produced by the COVID-era fiscal and monetary stimulus are high enough to be genuinely painful for every over-leveraged borrower in the financial system: governments, corporations, and households. Reducing interest rates to relieve the debt service pressure would risk reigniting the inflation that the rate increases were deployed to suppress. Maintaining interest rates at current levels continues the financial stress on the over-leveraged borrowers and risks the specific cascade of defaults and financial institution stress that high rates and heavy debt levels historically produce when sustained long enough. The Federal Reserve is, in the specific technical sense, trapped between inflation that rises if rates are cut and financial stress that accumulates if rates are maintained. The resolution of this trap historically involves either a financial system event that forces emergency rate cuts, a significant bank failure, a credit market seizure, a market dislocation of sufficient magnitude that the Fed's financial stability mandate overrides its inflation mandate, or the slow, painful process of financial deleveraging where over-leveraged borrowers gradually reduce debt at the cost of the economic growth that debt reduction requires sacrificing. Neither resolution is painless. Both resolutions produce specific economic disruption that will be felt throughout the economy. The question is not whether the pain arrives, but when and in what form. Chapter 3: The Inflation That Won't Quit. Why your purchasing power is being permanently restructured. Here's the economic development that most directly connects the geopolitical and financial risks described in the previous chapters to the daily lived experience of most people. the specific inflation dynamic that has not resolved in the way that official narratives have repeatedly predicted, and that is producing a permanent restructuring of purchasing power that most people have not fully absorbed. Inflation peaked in the United States at approximately 9% in June 2022, the highest level in 4 decades. By the time of this video's production, it had declined significantly from that peak. The conventional narrative presents this decline as the story of successful monetary policy bringing inflation under control and returning to the Fed's 2% target. The more complete narrative is more uncomfortable, the sticky inflation reality. Why coming down doesn't mean solved. Here's the distinction between declining inflation and controlled inflation that the optimistic framing of the inflation story consistently obscures. The price level does not return to its pre-inflation baseline when inflation comes down from its peak. The prices that rose during the 2021 to 2023 inflationary episode are not going back down. They are the new baseline from which future inflation is measured. The grocery store that cost $200 per week in 2020 costs approximately $280 per week in 2024. A decline in the grocery price inflation rate from 12% to 2% does not mean groceries cost $200 per week again. It means they go from $280 to approximately $285.60 the following year, rather than from $280 to $313.60. The burden of the accumulated inflation remains permanently embedded in the price level. It is the new reality of purchasing power, not a temporary condition that resolves when the inflation rate normalizes. This distinction matters enormously for the household whose wage growth has not kept pace with the accumulated price level increase, which is the majority of American households. Real wages, wages adjusted for inflation, have declined for most workers over the 2020 to 2024 period, despite the nominal wage growth that the employment data celebrates. The worker who received a 15% nominal wage increase from 2020 to 2024 while prices increased. 20% has experienced a 5% real wage decline, a genuine measurable reduction in living standards that the nominal figures obscure, the housing inflation trap, the permanent cost increase that changed the middle class. Here's the specific inflation category that has done the most permanent damage to the most people. The housing cost increase that has restructured the economic reality of every household that is not already in stable, affordable housing. The median home price in the United States increased from approximately $310,000 in early 2020 to approximately $420,000 at peak, a 35% increase in approximately 2 years. The combination of this price increase with the interest rate increase from near 0 to 7% plus has produced a monthly mortgage payment for the median-priced home that has approximately doubled from 2020 levels. The household that could comfortably afford a median home in 2020 on a median income cannot afford the same home today at a reasonable debt-to-income ratio. The rental market has experienced similar dynamics. Median rents increased 25% to 40% in most major markets from 2020 to 2023. The supply response, new apartment construction, has provided some relief in specific markets, but has not come close to restoring the affordability that existed before the pandemic-era housing price spike. The specific economic consequence of housing cost inflation. Housing costs are the largest single expenditure in most household budgets. When housing costs double as a fraction of income, every other spending category must compress proportionally. The household that is spending 40% of income on housing rather than 25% has 15% less of its income available for food, transportation, healthcare, savings, and every other expenditure category. This compression is the specific financial reality underlying the consumer sentiment data that consistently shows Americans rating current economic conditions poorly despite strong employment. And headline GDP growth. The services inflation persistence. The wage price dynamic that central banks fear. Here's the specific inflation category that the Federal Reserve has identified as its primary remaining concern. The services inflation that has proven most persistent and most resistant to the conventional monetary policy tools deployed to reduce it. Services inflation, the rising cost of healthcare, education, insurance, haircuts, restaurant meals, childcare, and the full range of human labor-intensive services, is driven primarily by labor costs. When workers receive wage increases, which they did significantly during the post-COVID labor market tightening, the businesses that employ them raise prices to preserve their margins, which produces the inflation that reduces the real value of the wage increases, which produces demand for further wage increases, which produces further price increases. This wage-price dynamic is the specific inflation mechanism that central banks most fear because it is the most self-sustaining. Commodity inflation, energy prices, food prices, can be addressed by supply increases and demand reduction. Services inflation requires either a significant labor market weakening that reduces workers' bargaining power, which is to say, a recession, or a sustained period of real wage growth that outpaces price increases until the labor cost pressure normalizes. Neither outcome is comfortable, and neither is arriving quickly. The geopolitical inflation premium, the new permanent cost of an unsafe world. Here's the specific inflation driver that was not present in the previous era of globalization-driven deflation, and that represents a structural increase in the long-run inflation rate, rather than a temporary cyclical episode. The inflation premium, produced by the deglobalization of the world economy along geopolitical fracture lines. The deflationary era of 1990 to 2020 was substantially produced by the integration of China, Eastern Europe, and other low-cost manufacturing regions into the global supply chain, a process that reduced the cost of producing goods by accessing the lowest-cost labor and manufacturing available globally. This process is being partially reversed, not completely but meaningfully, by the geopolitical fragmentation that the US-China strategic competition, the Russia-Ukraine conflict, and the broader reorganization of the global order along national security lines has produced. Supply chain reshoring and friendshoring, the movement of manufacturing out of geopolitically risky locations toward domestic or allied country production, adds cost. The chips manufactured in Arizona cost more than the chips manufactured in Taiwan. The pharmaceuticals produced in domestic facilities cost more than the pharmaceuticals produced in India. The steel produced in domestic mills with domestic labor costs more than the steel imported from lower-cost producers. Every manufacturing decision made on national security grounds rather than pure economic efficiency grounds adds cost, and that cost shows up as inflation in the finished goods that use these more expensive inputs. This structural inflation premium, the persistent addition to the price level produced by the security premium on production location, is not addressable by interest rate policy. It is the specific cost of living in a world that has decided national security considerations should constrain pure economic optimization. It will persist as long as the geopolitical tensions that produce the supply chain reorganization persist, which, given the trajectory of US-China competition and the broader geopolitical environment, is likely to be measured in decades rather than years. Chapter 4. The AI Disruption, the economic transformation nobody is actually ready for. Here's the economic disruption that is simultaneously the most discussed topic in business media and the least adequately prepared for by the people who will be most affected by it. The artificial intelligence transition that is moving from the theoretical phase of impressive demonstrations to the practical phase of actual job displacement, actual business model disruption, and actual economic restructuring at a speed that the institutions and individuals in its path are not equipped to absorb. Let's be specific about what is happening and what is not happening, because the AI conversation is afflicted by two equally unhelpful extremes. The dismissive extreme, AI is just another technology cycle, the concerns about displacement are overblown, the economy will adapt as it always has, underestimates the specific characteristics of this technology that make it categorically different from previous automation waves. The apocalyptic extreme, AI will eliminate all jobs within 5 years, human economic participation is ending, we are months from the singularity, overestimates the speed and scope of deployment in ways that produce fatalism rather than useful preparation. The honest middle is more nuanced and more immediately actionable than either extreme. What makes AI different from previous automation waves? Here's the specific technical characteristic that makes the current AI transition qualitatively different from the previous waves of automation that the economy absorbed without the catastrophic job displacement that was predicted at the time, the specific feature that makes the dismissive comparison to the Industrial Revolution or the Computer Revolution analytically incomplete. Previous automation waves automated physical or computational tasks that were routine, rule-based, and explicitly programmable. The factory robot replaced the assembly line worker performing repetitive physical movements. The spreadsheet replaced the bookkeeper performing repetitive numerical calculations. The database replaced the filing clerk performing repetitive information retrieval. In each case, the automation targeted the routine and explicitly rule-defined, leaving the non-routine, creative, and interpersonal dimensions of work relatively unaffected. The current AI transition, specifically the large language model and multimodal AI capabilities that have emerged since 2022, is automating tasks that are explicitly non-routine, judgment-based, and previously considered to require human cognitive capability. The ability to synthesize information across large bodies of knowledge and produce specific, contextually appropriate outputs, the core capability of legal research, financial analysis, medical diagnosis support, software development, content creation, customer service, and a dozen other professional service categories is precisely what the current generation of AI systems does well. This is the specific characteristic that makes the comparison to previous automation waves incomplete. Previous waves automated the bottom of the cognitive skill distribution. The current wave is automating the middle and upper middle of the cognitive skill distribution, the specific knowledge work and professional service work that the previous automation waves displaced workers were told to retrain for. The specific job categories under immediate pressure. Here's the honest catalog of the job categories that are experiencing or will experience significant pressure in the near term. Not the long-term future speculation of what AI might eventually do, but the specific tasks and roles where the displacement is already documented and already accelerating. Entry-level knowledge work, the junior analyst, the junior associate, the entry-level paralegal, the junior software developer, positions that primarily involved the synthesis and summarization of information, the production of first drafts, the routine application of established frameworks to new situations. These positions exist as the training ground for the more senior roles in their respective industries, and AI can perform the core tasks of these positions at a fraction of the cost of a human junior employee. The specific consequence is not primarily that existing junior employees are being immediately fired, though some are. It is that new hiring at the junior level is being dramatically reduced, which compresses the pipeline into senior roles. Customer service and support, the Tier 1 and Tier 2 customer service function, the handling of routine customer inquiries, the resolution of standard problems, the routing of complex issues to human specialists, is being rapidly replaced by AI systems that are available continuously, infinitely scalable, and capable of handling the vast majority of routine customer interactions without human involvement. The customer service job that employed tens of millions of Americans is contracting with a speed and scale that the employment data has not fully captured because the layoffs are being partially offset by growth in other sectors. Content creation at scale, the production of routine content, product descriptions, financial summaries, news articles summarizing data releases, marketing copy for standard applications, is being automated at a speed that is producing measurable contraction in the employment of writers, editors, and content producers who specialized in high-volume, lower-complexity content production. Coding and software development at the junior to mid-level, AI coding assistants have demonstrably increased the productivity of software developers, which is a benefit for the individual developer, but a reduction in the number of developers required to produce a given amount of software. The specific effect is already visible in technology company hiring data, which has declined significantly from the peak hiring years of 2020 to 2022. The productivity paradox, why AI growth doesn't automatically mean shared prosperity. Here's the specific economic dynamic that makes the AI disruption more complex than either the optimistic or pessimistic framing captures. The productivity paradox that occurs when technological advancement produces significant economic output growth while simultaneously producing distributional consequences that leave the majority of people economically worse off in relative terms. The economic history of productivity improvements is not uniformly positive for workers. The gains from productivity improvements accrue to the owners of the capital that enables the productivity improvement, the shareholders who own the AI systems, the executives whose compensation is linked to corporate profitability, and to the workers whose skills are complemented rather than replaced by the technology. The workers whose skills are substituted by the technology receive none of the productivity gain and bear the full cost of the displacement. The AI productivity gains that are already visible in corporate earnings, the legal firm that produces twice the work product with half the junior associates, the software company that ships 3 times the code with the same number of senior engineers, the financial institution that processes 10 times the customer inquiries with a fraction of the customer service staff, flow to the owners of those firms and to the senior employees who remain. They do not flow to the junior employees who have been replaced or to the communities whose employment base has contracted. The macro-level GDP growth that AI-enabled productivity improvement produces may therefore coexist with micro-level economic deterioration for the specific workers most affected by the displacement, producing the specific political and social tensions that have historically accompanied technological transitions of this scale and speed. The timeline, faster than you think, slower than the headlines suggest, here's the honest timeline assessment for the AI economic disruption, calibrated against the specific evidence of what is already happening rather than against either the most optimistic or the most catastrophist projections. The disruption that is already happening right now in 2024 to 2026, junior knowledge work hiring contraction, customer service automation expansion, content creation commoditization, and software development productivity amplification. These are not future scenarios. They are current realities that are producing measurable employment changes in specific sectors. The disruption that is likely in the 2 to 5 year window, significant displacement in paralegal and legal research work, financial analysis and reporting, medical coding and administrative functions, middle management coordination functions, and the full range of knowledge work that can be reduced to the synthesis and application of existing information. The specific timing will be determined by regulatory environment, enterprise adoption curves, and the specific capability improvements in AI systems that are ongoing and accelerating. The disruption that remains genuinely uncertain beyond 5 years, the physical world integration of AI, the robotics application that extends AI capability from the digital to the physical domain, which would expand displacement to manufacturing, logistics, healthcare delivery, and construction. The timeline here is genuinely uncertain because it depends on hardware development, regulatory approval, and deployment economics that are not yet determinable with confidence. The preparation implication, the near-term disruption, the next 2 to 5 years, is the one that requires immediate attention because it is affecting or about to affect the employment of specific people in specific roles right now. The longer-term disruption is worth understanding for educational and career development planning but is too uncertain in timing to demand immediate behavioral response. Chapter 5. The Geopolitical Fracture: How a World Breaking into Blocks Changes Everything. Here's the structural change in the global economy that is the slowest moving of the risks described in this video and the one with the most profound long-term consequences for economic life. The specific reorganization of the global order that is converting the integrated rules-based international system of the post-Cold War era into a fragmented bloc-based system where the economic and security relationships are determined by geopolitical alignment rather than comparative advantage. This transition is not a future scenario, it is an ongoing process that is already producing specific measurable economic consequences in supply chain reorganization, in trade pattern shifts, in currency reserve allocation, in technology standard bifurcation, and in the full range of economic relationships that the previous era of globalization had organized around efficiency rather than security. The US-China decoupling, the most consequential economic divorce in history. Here's the specific geopolitical fracture that has the largest economic implications: the deliberate, systematic, and accelerating reduction of economic interdependence between the United States and China that is being pursued by both governments simultaneously, with bipartisan support in the US and with strategic intention in China. The US-China economic relationship at its peak, approximately 2015 to 2018, was the most significant bilateral trade relationship in modern history. China was the factory of the world, and the United States was its largest market. The interdependence was so deep that the prospect of deliberate decoupling seemed economically irrational. The costs of separation were too large for either party to willingly accept. The strategic logic that has overridden the economic logic. Both governments have concluded that the security risks of deep economic interdependence with a strategic competitor outweigh the economic benefits of continued integration. The United States has concluded that China's access to advanced technology, semiconductors, AI systems, aerospace components, enables military capabilities that threaten U.S. security interests. China has concluded that U.S. control of the technology supply chain, the semiconductor manufacturing equipment, the cloud computing platforms, the financial infrastructure, represents a strategic vulnerability that reduces China's effective sovereignty. The specific economic consequences of the decoupling that are already visible. U.S. tariffs on Chinese goods across multiple product categories, Chinese tariffs and export restrictions on specific critical minerals and materials, U.S. export controls on advanced semiconductors and semiconductor manufacturing equipment to China, Chinese restrictions on the activities of U.S. technology and consulting firms operating in China, the gradual withdrawal of supply chains from China to alternative locations, Vietnam, Mexico, India, Eastern Europe, at significant cost and with significant inefficiency relative to the optimized supply chains they replace. The long-term economic consequence. The global economy that was optimized for a single integrated market is being restructured into two parallel economic systems, a US-aligned system and a China-aligned system, with limited overlap and significant duplication of productive capacity. This duplication is economically inefficient. It produces more of the things the world needs at higher cost and with lower overall productivity than a fully integrated system would. The inflation premium of this inefficiency is the specific economic cost that every consumer pays for the strategic security benefit that the decoupling is intended to provide. The dollar dominance question, the currency that holds everything together. Here's the specific financial architecture that underlies the entire global economic system, and that is experiencing its first serious challenge in decades. The US dollar's reserve currency status and the specific financial advantages it provides to the United States and the specific vulnerabilities it creates for every other economy. The dollar's reserve currency status means that international trade is predominantly denominated in dollars, that foreign central banks hold dollars as their primary reserve asset, and that global commodity markets, oil, gold, agricultural products, are priced in dollars. This creates the specific U.S. advantage of being able to run large trade deficits without the currency crisis that would afflict any other country with comparable deficits, because the global demand for dollars to facilitate international trade provides a persistent buyer for the dollars that U.S. trade deficits produce. The challenge to this system, the U.S. use of dollar financial system access as a sanctions weapon, most dramatically in the freezing of Russian central bank reserves following the Ukraine invasion, has caused every government that considers itself a potential future sanctions target to reassess its dependence on dollar reserves and dollar-denominated trade. China, Russia, Saudi Arabia, India, Brazil, and other significant economies have been actively developing alternative payment systems, bilateral trade agreements in non-dollar currencies, and gold accumulation strategies specifically designed to reduce vulnerability to dollar financial system weaponization. The specific economic consequence of partial dollar reserve erosion, if the dollar's share of global reserves declines significantly, from the current approximately 58% to something closer to 40% to 45%, the persistent global demand for dollars that has supported the U.S.'s ability to finance its fiscal deficits at favorable rates would decline. The specific financial physics, less global. Demand for dollars means fewer buyers for U.S. Treasury bonds, which means higher interest rates required to attract buyers, which means higher U.S. government debt service costs, which means a more acute version of the fiscal crisis described in Chapter 2. The timing of this transition is genuinely uncertain. The dollar's institutional advantages are deep and durable enough that the erosion of reserve status is a process measured in decades rather than years. But the direction of the trend is clear, and the specific events that could accelerate it, a U.S. fiscal crisis, a significant U.S. foreign policy decision that drives additional reserve diversification, the development of genuinely functional alternative payment infrastructure, are more probable now than at any point in the post-Bretton Woods era. The energy transition geopolitics, the race that is producing new dependencies. Here's the specific dimension of the geopolitical fracture that is most directly connected to the energy security concerns raised in Chapter 1, the specific geopolitical implications of the global energy transition from fossil fuels to renewables, which is producing new resource dependencies and new strategic vulnerabilities even as it addresses the climate and energy security motivations that are driving it. The clean energy transition requires specific critical minerals, lithium, cobalt, nickel, rare earth elements, copper, in quantities that dwarf current production capacity and that are geographically concentrated in ways that create new strategic vulnerabilities alongside the elimination of existing fossil fuel vulnerabilities. Lithium is concentrated in the lithium triangle of South America, Bolivia, Chile, Argentina, and in Australia. Cobalt is concentrated in the Democratic Republic of Congo, where Chinese mining companies have established dominant production positions. Rare earth elements critical for electric motors and wind turbines are dominated by Chinese production and processing capacity. The clean energy supply chain is, in specific ways, more Chinese dependent than the fossil fuel supply chain it is replacing. The specific strategic implication: the United States and its allies are transitioning from dependence on Middle Eastern oil, which is at least produced by multiple competing suppliers and traded on global markets, to potential dependence on Chinese-controlled critical mineral supply chains. The geopolitical risk has not been eliminated by the energy transition. It has been partially relocated. The Taiwan risk, the supply chain catastrophe that could dwarf the Middle East scenario. Here's the geopolitical risk that this video must acknowledge, even as it focuses primarily on the Middle Eastern scenario, the Taiwan situation that represents the most extreme economic catastrophe scenario available in the current geopolitical environment. Taiwan produces approximately 90% of the world's most advanced semiconductors through TSMC, Taiwan Semiconductor Manufacturing Company. These chips are the essential input for every sophisticated electronic device, every AI system, every modern weapons platform, and every data center in the world. The geographic concentration of this production in a territory that China explicitly claims as its own and has explicitly committed to reunifying by force if necessary represents a supply chain vulnerability that has no precedent in the global economy. A military conflict over Taiwan, or even a credible military crisis that disrupted TSMC production, would produce a semiconductor shortage that would shut down significant portions of global manufacturing, technology, and military production simultaneously. The automotive industry, the consumer electronics industry, the defense industry, and the data center industry would all face production shutdowns whose economic consequences would be measured in the trillions of dollars. The market currently prices this risk as very low probability. The strategic logic of why China has not acted, the economic interdependence, the military capability gap that is closing but not yet closed, the specific calculation of costs and benefits that has so far favored patience, is sound. But the trend lines, Chinese military capability improvement, Taiwanese defensive capability development, U.S. deterrence posture, and the specific Chinese leadership dynamics are not static. The window of deterrence stability that has maintained the status quo is not guaranteed to remain open indefinitely. Chapter 6. The Market Valuation Problem: Why Stocks Might Not Save You. This time, here's the chapter that connects the macroeconomic and geopolitical risks of the previous chapters to the specific financial asset that most people are depending on to fund their retirement, protect their purchasing power, and provide the financial security that the economic environment is threatening from multiple directions simultaneously: the stock market. The uncomfortable truth about the stock market in the current environment is specific and important to state clearly before the actionable preparation framework of the later chapters. The equity market is priced for a future that may be significantly more optimistic than the environment described in the previous chapters justifies, and the specific valuation levels at which U.S. equities are trading provide limited cushion against the downside scenarios that the risks described in this video represent. The valuation context: Why starting point matters. Here's the specific valuation data that provides the most important context for understanding the stock market's current risk profile, the relationship between current prices and historical earnings that determines the expected return on equity investment from current levels. The cyclically adjusted price-to-earnings ratio, the Shiller CAPE ratio, measures the price of the S&P 500 relative to average inflation-adjusted earnings over the previous 10 years. It currently sits at levels that have historically been associated with low subsequent returns and elevated subsequent volatility. The specific historical pattern, CAPE ratios above 30, have been followed over the subsequent 10-year periods for which data exists by returns significantly below the historical average, and in several cases, by significant absolute declines. This is not a market timing prediction. The CAPE ratio has been elevated relative to its historical average for much of the past decade without producing the below-average returns that historical relationships would predict, because the interest rate environment of the 2000s depressed the discount rate applied to future earnings, making high PE ratios more justifiable than in previous high-rate environments. But interest rates are no longer at the lows of the 2000s, and the mathematical relationship between interest rates and appropriate equity valuations suggests that current CAPE levels are harder to justify at current rates than they would have been in the zero-rate environment. The concentration problem. When 7 stocks are the market. Here's the specific structural feature of the current equity market that makes the headline index performance an increasingly misleading guide to broad market health. The extraordinary concentration of the major U.S. equity indices in a small number of extraordinarily large technology and technology-adjacent companies. The 7 largest companies in the S&P 500, Apple, Microsoft, Nvidia, Alphabet, Amazon, Meta, and Tesla, collectively represent approximately 30% of the total index market capitalization. This means that the performance of the S&P 500 index is largely determined by the performance of 7 companies, and those 7 companies are all exposed to the specific risks of the AI transition, the geopolitical technology competition, the regulatory environment for large technology platforms, and the specific valuation pressures of high-rate environments on long-duration growth stocks. The specific investment risk this concentration creates. The investor who believes they are diversified through S&P 500 index fund ownership has approximately 30% of their equity portfolio concentrated in 7 companies, all of which share significant common risk factors. A regulatory development that affected all large technology platforms, a genuinely possible scenario given the bipartisan political concern about platform power, would affect all 7 simultaneously. A significant AI investment disappointment, the scenario where AI revenue fails to materialize at the pace that AI infrastructure investment implies, would affect most of them simultaneously. The earnings dependency, the AI bet, that equity markets have already made. Here's the specific earnings assumption that is embedded in current equity market valuations, and that represents the most significant specific risk to the equity market from the macroeconomic scenarios described in this video. The bet that the AI investment cycle will produce the revenue growth that the infrastructure investment implies. The hyperscalers, Amazon, Microsoft, Google, Meta, are collectively spending hundreds of billions of dollars annually on AI infrastructure, the chips, the data centers, the power infrastructure, the software development. This spending is reflected in the current earnings of the companies that supply the infrastructure, most dramatically Nvidia, whose revenue growth has been extraordinary. The investment community has assigned this AI infrastructure spending a specific return expectation, the expectation that it will produce AI-enabled products and services that generate revenue sufficient to justify the investment at standard return on capital benchmarks. The specific risk: the revenue applications for AI have not yet materialized at the scale that the infrastructure investment implies. The AI productivity improvements are real. The AI revenue, the products that customers pay significant incremental amounts for in quantities that justify hundreds of billions of dollars of infrastructure investment, are still in the early stages of development and adoption. If the timeline between AI infrastructure investment and AI revenue realization is longer than the equity market's current pricing implies, the specific earnings disappointment scenario would produce a significant valuation compression in the technology sector that constitutes such a large fraction of the overall index. The interest rate sensitivity, Why bonds aren't the safe haven they were. Here's the specific portfolio construction problem that the current environment creates. The failure of the traditional stock bond portfolio allocation to provide the diversification benefit that it reliably provided in the previous era of low inflation and low interest rates. The traditional 60-40 portfolio, 60% equities and 40% bonds, provided diversification because equities and bonds were negatively correlated. When stocks fell during recessions, bonds rose as the Federal Reserve cut interest rates in response to the economic weakness. The bond allocation cushioned the portfolio against the equity decline. In an inflationary environment, this correlation inverts. Stocks fall because inflation erodes corporate margins and consumer purchasing power. Bonds also fall because inflation erodes the real value of fixed coupon payments, and because the Fed raises rates to combat inflation, which reduces bond prices. The 2022 episode was the most dramatic demonstration of this correlation inversion in modern investment history. Both stocks and bonds fell simultaneously, producing the worst year for the traditional 60-40 portfolio since the stagflation era of the 1970s. If the inflation scenarios described in chapters 2 and 3, the sticky services inflation, the geopolitical inflation premium, the potential energy price spike from Middle Eastern escalation, produce a prolonged period of elevated inflation alongside economic slowdown, the traditional portfolio construction assumption fails. The bond allocation that was supposed to protect the portfolio during equity market stress provides no protection and may amplify losses in an environment where both assets respond negatively to the same inflationary shock. The liquidity risk. What happens when everyone tries to exit at once? Here's the final equity market risk that deserves specific attention. The specific liquidity risk that market structure changes have introduced to the equity market over the past decade in ways that make the potential severity of a market decline greater than historical experience would suggest. The growth of passive investing. The shift from active stock selection to index fund investing has changed the market's response to selling pressure in ways that are not fully understood and that have not been tested through a full stress scenario. When active managers sell, they sell specific stocks they believe are overvalued, providing a stabilizing force on stocks they still believe are attractively priced. When passive investors sell, by redeeming index fund shares, the fund must sell all stocks in the index proportionally, regardless of individual stock valuation. In a panic selling scenario, large-scale passive redemption amplifies rather than stabilizes the market decline by forcing proportional selling across all stocks simultaneously. The options market amplification. The growth of zero-data expiration options trading that requires dealers to continuously hedge by buying and selling underlying stocks adds additional feedback loop risk to market structure. Large directional moves in the market trigger options. Dealer hedging that amplifies the move rather than dampening it, potentially converting what would have been an orderly correction into a sharper, faster decline. Neither of these structural features guarantees a market crash. They suggest that when a significant market decline begins, for whatever combination of fundamental reasons the environment produces, the decline may be faster and deeper than historical precedent suggests before the stabilizing mechanisms, value investors, corporate buybacks, long-term institutional buyers, are activated. Chapter 7. The Housing Crisis. The American Dream that became the American Trap. Here's the economic disruption that is most directly and most immediately affecting the daily quality of life of the largest number of Americans. The housing market dysfunction that has simultaneously made homeownership inaccessible for an entire generation of younger Americans, trapped existing homeowners in their current homes through the golden handcuff of their low-rate mortgages, and created the specific economic fragility that a housing market correction would produce in a financial system where residential real estate represents the largest asset class. The housing situation is not a simple story of supply and demand imbalance that will resolve through additional construction. It is a specific, multi-layered structural problem with components that are not easily addressable through the conventional policy tools available to the governments attempting to address them. The affordability collapse. Numbers that make previous generations seem lucky. Here's the specific affordability data that most clearly illustrates the scale of the housing dysfunction. numbers that put the current situation in historical context, that makes clear this is not a normal cyclical housing market correction, but a genuine structural break in the relationship between housing costs and incomes. The Housing Affordability Index, maintained by the National Association of Realtors, measures whether a family earning the median income can qualify for a mortgage on a median-priced home at current interest rates. An index value of 100 means the median income family can exactly afford the median-priced home. Values above 100 indicate affordable conditions. Values below 100 indicate unaffordable conditions. The Affordability Index reached its worst level in recorded history in 2023, below 100 for the first time in decades, meaning that the median income family cannot qualify for a mortgage on the median-priced home at prevailing interest rates. The specific arithmetic: the median home price of approximately $420,000, financed at 7.5% for 30 years, produces a monthly payment of approximately $2,940. At a conventional 28% front-end debt-to-income ratio, this payment requires an annual income of approximately $126,000, significantly above the U.S. median household income of approximately $74,000. The household earning the U.S. median income cannot afford the median-priced home in most U.S. markets. This is the specific definition of a broken housing market, a market where the middle of the income distribution cannot access the middle of the price distribution, and it is the current reality of American housing. The lock-in effect: why supply won't fix the problem. Here's the specific mechanism that is preventing the housing market from clearing through the conventional supply and demand mechanism: the rate lock-in effect that is holding approximately 85% to 90% of existing homeowners out of the transaction market and keeping the supply of homes for sale at historically low levels despite the unaffordability that would normally motivate sellers to capture their equity. Approximately 60% of outstanding U.S. mortgages carry interest rates below 4%. The homeowner with a $400,000 mortgage at 3.5% is paying approximately $1,796 per month. If they sell their home and purchase a comparable home in the current market at a similar price point but at 7.5% interest, their payment increases to approximately $2,797 per month, a $1,001 monthly increase for the same home. The financial disincentive to move is $12,012 per year just from the mortgage rate change, before accounting for transaction costs, moving costs, and the disruption of the move itself. This lock-in effect is suppressing housing supply in a way that has no historical precedent in the data series, because previous housing market cycles never involved the combination of the lowest mortgage rates in history followed by the fastest rate increase in 40 years. The homeowners who locked in sub-3% mortgages in 2020 and 2021 are effectively trapped in their current homes by the rate differential, not by force, but by the specific financial logic that moving would significantly increase their housing cost for no improvement in housing quality. The economic consequence is a housing market that has seized up. High prices, low inventory, low transaction volume, in a way that affects economic mobility, labor market flexibility, and the wealth inequality between homeowners and renters in ways that will persist for as long as the rate differential continues. The commercial real estate crisis, the slow-motion disaster in the financial system. Here's the housing-adjacent real estate crisis that is less visible in daily life than the residential affordability problem, but more immediately dangerous to the financial system. The commercial real estate correction that is producing significant losses in the loan portfolios of the banks that financed the commercial real estate expansion of the 2010s. Office real estate has experienced the most dramatic structural change. The permanent shift toward remote and hybrid work that the pandemic normalized has produced vacancy rates in major U.S. office markets that are, in many cities, at historic highs. Office vacancy in San Francisco, Chicago, Houston, and other major markets exceeds 20% to 30% in some submarkets. Levels that reflect not a cyclical decline in office demand, but a structural reduction in the amount of office space that the economy will ever use again. The financial plumbing problem: approximately $1.5 trillion in commercial real estate loans are maturing between 2024 and 2027. These loans were made against property values that were established in the low-rate, full occupancy environment of the mid-2000s. The current property values, reflecting higher capitalization rates from higher interest rates and lower net operating income from lower occupancy, are significantly below the loan values in many cases. The specific term for this situation is underwater. The property is worth less than the loan secured against it, and the resolution options are all painful. The owner can inject additional equity to refinance, the bank can take a loss and foreclose, or the owner can default and the bank can recognize the loss. The specific banking system risk. The banks most exposed to commercial real estate losses are the regional and community banks, the smaller institutions that provide the majority of small business lending in the United States, and that are critical to the functioning of local economies. A wave of commercial real estate losses concentrated in regional banks produces the specific combination of bank stress and small business lending contraction that leads to the broader economic slowdown that the large bank stress tests don't adequately capture. What housing means for the broader economy. Here's the specific economic transmission mechanism that makes the housing market's dysfunction consequential for the overall economy rather than merely for the real estate industry. The specific ways that housing market health affects consumer spending, labor market mobility, financial system stability, and the wealth distribution that determines consumer demand. The wealth effect from housing. For most American households, the primary residence is the largest single asset. When housing values rise, the household wealth effect supports consumer confidence and consumer spending. When housing values decline, particularly in the scenario where rates remain elevated and the affordability-induced demand suppression eventually results in price correction, the wealth effect reversal produces consumer spending contraction that is transmitted through the broader economy. The labor market mobility effect, the rate lock-in effect described above, suppresses geographic labor market mobility. Workers who cannot afford to move because of the rate differential between their current mortgage and the prevailing market rate cannot follow employment opportunities to different markets. This labor market rigidity reduces economic efficiency and limits the wage growth that geographic mobility between labor-scarce and labor-surplus markets produces. The generational wealth effect. The homeownership rate for Americans under 35 has declined significantly from previous generations, reflecting the affordability barriers described above. The generation that is locked out of home ownership at the ages when previous generations built their primary asset base will carry that wealth gap forward, with specific consequences for retirement security, intergenerational wealth transfer, and the consumer spending that home ownership historically supports through the furniture, appliance, renovation, and services purchases that accompany home purchase and ownership. Chapter 8. The Political Economy Risk. When economic stress produces political instability. Here's the dimension of the economic risk picture that is most consistently underweighted in financial analysis. Because financial analysts are trained to analyze economics rather than politics, the specific ways that the accumulated economic stresses described in the previous chapters interact with the political environment to produce policy responses, social instability, and institutional changes that feed back into the economic environment in ways that can amplify rather than resolve the original economic disruptions. Economic stress and political instability have a well-documented historical relationship. The specific mechanism, economic hardship, unemployment, inflation, declining real wages, housing unaffordability, debt burden, produces political discontent that makes voters more receptive to extreme or unconventional political solutions. The extreme or unconventional political solutions, once in power, produce policies that are often economically counterproductive, protective tariffs that reduce economic efficiency, fiscal expansions that worsen the debt situations they are supposed to address, regulatory environments that reduce investment, which deepens the economic hardship that produced the political instability in the first place. The populism-inflation feedback loop. Here's the specific political economy dynamic that is most immediately relevant to the economic outlook. The interaction between the economic grievances that have produced elevated political populism across the developed world and the economic policies that populist political movements tend to implement. The economic grievances that have produced political polarization in the United States and across the developed world are specific and legitimate. the real wage stagnation of the middle and working class relative to the top decile, the housing affordability collapse that has locked younger generations out of asset accumulation, the healthcare cost burden that falls most heavily on households not covered by employer plans, the education cost burden that has produced the student debt crisis, and the general sense that the economy is structured to benefit those who already have assets at the expense of those who are trying to accumulate them. The policy responses that these grievances produce under populist political movements consistently include protective tariffs and trade restrictions that reduce economic efficiency and increase consumer goods prices, fiscal expansions that address grievances through government spending at the cost of the fiscal sustainability already under stress, and regulatory approaches that prioritize political objectives over economic efficiency in ways that reduce investment and innovation. The specific economic risk, the tariff increases that have been implemented and that have been discussed as potential future policy, are inflationary. They raise the price of imported goods for American consumers and businesses, adding to the inflationary pressures already present in the system. The fiscal expansions that are politically demanded, in the form of student debt relief, healthcare subsidies, housing assistance, industrial policy, add to the deficit trajectory that the debt supercycle chapter identified as unsustainable. The interaction of politically driven inflation with structurally elevated deficits is the specific recipe for the fiscal inflation crisis that has destroyed the economic stability of multiple emerging market economies over the past 3 decades, and that has, historically, not been exclusive to emerging markets. The social cohesion question. The economic foundation of political stability. Here's the dimension of the political economy risk that is most difficult to quantify but most important to understand: the relationship between economic inequality, social cohesion, and the institutional stability that the economic system depends on. Modern economies are extraordinarily complex institutional systems that function because of the specific social trust that underlies them. Trust in contracts, trust in property rights, trust in currency, trust in the regulatory framework, trust in the institutions that enforce all of the above. This institutional trust is not a physical characteristic of the economic system. It is a social characteristic that is sustained by the ongoing experience of the system being fair enough, functional enough, and beneficial enough to enough people that the majority maintains the legitimacy of the institutions rather than working to undermine or circumvent them. The specific economic inequality trajectory of the past 3 decades has created the conditions under which this institutional trust is being tested, not in the dramatic sense of imminent revolution, but in the specific, gradual sense of declining institutional confidence that makes the system less stable, less resilient to shocks, and less capable of the coordinated response that significant economic challenges require. The economic consequence of declining institutional trust is specific: reduced long-term investment by actors who are uncertain about the stability of the property rights and regulatory framework their investment depends on. Reduced compliance with the tax and regulatory system by actors who don't believe the system is being enforced fairly. Reduced labor market participation by workers who don't believe the employment market will reward their participation at the rates the official economic narrative implies. Each of these behavioral responses to declining institutional trust is economically contractionary, and they accumulate gradually in ways that are difficult to measure and easy to miss until they reach a threshold where the contraction becomes self-reinforcing. Chapter 9. The Climate Economic Risk. The Costs that are already arriving. Here's the economic risk that is the longest in its time horizon, the most politically contested in its characterization, and the most already present in its financial consequences. The specific economic costs that climate change is already producing through the specific mechanisms of physical damage, insurance market disruption, agricultural stress, and the transition costs of the energy system restructuring that the climate trajectory demands. This chapter is not a climate science discussion. It is a specific economic analysis of the financial costs that are already visible and already growing. Costs that are affecting insurance premiums, agricultural commodity prices, infrastructure spending, and the specific regional economies most exposed to the physical risks of the climate trajectory, the insurance market disruption, the canary in the coal mine. Here's the most immediately financially visible consequence of the climate risk trajectory: the the specific disruption in the insurance market that is producing insurance premium spikes, coverage withdrawal, and the specific financial vulnerability that the loss of affordable insurance creates for homeowners, businesses, and local governments in the most exposed regions. The insurance market functions by pooling risk across a large population of policyholders. The many pay premiums so that the few who experience losses are made whole. This mechanism works when losses are random, uncorrelated, and bounded, when the probability and severity of claims in any given period is predictable enough to be priced into premiums that the broad population of policyholders can afford. The climate trajectory is disrupting this mechanism in specific regions by making losses larger, more correlated, affecting entire regions simultaneously rather than individual properties, and more frequent than the historical data that the insurance pricing models were built on. The specific consequences are visible. State Farm and Allstate withdrew from the California homeowners insurance market. Florida's property insurance market has experienced multiple insurer insolvencies and dramatic premium increases. The National Flood Insurance Program, the federal backstop for flood coverage, is chronically underfunded relative to its exposure. Crop insurance premiums are rising across the agricultural Midwest as precipitation pattern changes increase crop failure frequency. The economic consequences of insurance market disruption: the uninsurable home cannot be sold with mortgage financing, which removes most buyers from the market and collapses property values. The uninsurable business cannot secure the financing that its operations depend on. The municipality that cannot obtain affordable disaster recovery financing cannot maintain the infrastructure investments that make it economically viable. The cascade from insurance unaffordability to property value collapse to local government fiscal stress to broader economic deterioration is the specific sequence that makes insurance market disruption an economic risk rather than merely an inconvenience for affected property owners. The agricultural stress. Food security in a changing climate. Here's the climate. Economic risk with the most direct connection to the inflation dynamics described in Chapter 3. The specific stress on agricultural production that changing precipitation patterns, temperature extremes, and the increased frequency of extreme weather events is producing in the major agricultural regions of the world. The global food system is more concentrated and more interconnected than most people realize. The specific agricultural regions that produce the majority of the world's caloric supply, the U.S. Corn Belt, the Ukrainian breadbasket, the Indian subcontinent's agricultural zones, the Brazilian Cerrado, are all experiencing the specific disruptions of the climate trajectory: more frequent drought in some regions, more frequent flooding in others, more frequent heat stress events during critical crop development periods, and the general unpredictability of precipitation and temperature patterns that the highly optimized modern agricultural system was not designed to accommodate. The specific food security risk is not primarily about current average conditions. The global agricultural system is producing adequate calories in most years. It is about the tail risk scenarios, the simultaneous crop failures in multiple major producing regions in a single year, that the climate trajectory makes meaningfully more probable than historical frequency. The global food system has approximately 90 days of grain reserves at any given time. A simultaneous significant crop failure in 2 or 3 major producing regions would exhaust those reserves and produce the food price spikes that have historically produced both severe human suffering and political instability in food importing nations. Chapter 10. The Technology of Financial Disruption, CBDCs, Crypto, and the Battle for Monetary Control. Here's the chapter that addresses the specific technology-driven changes to the monetary and financial system that are being developed and deployed simultaneously by governments, central banks, and private actors, changes that represent both genuine financial innovation and specific risks to individual financial privacy and autonomy that deserve explicit acknowledgement alongside their potential benefits. The CBDC project eared the government's new visibility into your wallet. Here's the specific monetary technology development that is furthest along in the policy implementation pipeline and that has the most direct implications for individual financial privacy and autonomy: the central bank digital currency, or CBDC, that more than 130 countries are currently researching, developing, or piloting. A CBDC is a digital form of a country's currency, dollars, euros, yuan, issued directly by the central bank, rather than through the commercial banking system. The technical capability that this structure enables is specific and significant. The central bank issuing a CBDC can, in principle, observe every transaction in the CBDC system in real time, who paid whom, for what, when, and where. This is a surveillance capability that the current banking system approximates but does not achieve. Cash transactions remain private, and while commercial banks report suspicious transactions and provide data to tax authorities, the data collection is partial and delayed rather than comprehensive and real-time. The specific financial implications of CBDC implementation that go beyond privacy, the programmability feature that some CBDC designs include, which would allow the currency itself to have built-in rules about how it can be spent, by whom, and within what time period. A programmable CBDC could, technically, implement negative interest rates that encourage spending by reducing the value of held balances, restrict spending to approved categories, expire unused balances, or distribute welfare payments that can only be used for specific purchases. Whether these programmability features will be implemented in practice depends on the political choices of the governments deploying CBDCs. The technical capability exists, and the regulatory and political safeguards that would prevent its use require the kind of institutional trust that the political economy chapter described as being under strain. The crypto question, hedge or speculation, here's the specific financial technology that was positioned by its proponents as the alternative to the CBDC's surveillance capability, the decentralized cryptocurrency ecosystem, and its specific utility as a financial privacy and inflation hedge tool, alongside its specific risks as a speculative asset class. Bitcoin, the oldest and most established cryptocurrency, was explicitly designed as an alternative to government-controlled currency, a digital asset with a fixed supply that cannot be inflated away by government money creation and that can be transacted without the intermediation of the banking system. These design features provide specific utility in the specific scenarios: hyperinflation, capital controls, government financial surveillance, where the conventional financial system fails its users. The honest assessment of crypto's role in the economic scenarios this video describes: as a speculative asset in a stable financial environment, cryptocurrency offers high volatility exposure to an asset class with uncertain long-term fundamental value. As a hedge against the specific tail risks of monetary system failure, the hyperinflation scenario, the capital control scenario, the financial system access denial scenario, a modest position in Bitcoin provides specific insurance against the scenarios where the conventional financial system is most likely to fail. The position sizing that is consistent with honest risk assessment, 3% to 7% of a diversified portfolio in Bitcoin as tail risk insurance, sized specifically to survive a total loss without catastrophic portfolio damage. While providing meaningful participation in the scenario where Bitcoin's specific utility is realized. Nothing more, and definitely not the 30% to 50% allocation that some cryptocurrency advocates suggest as the appropriate response to the economic risks described in this video. Chapter 11. The Preparation Framework. What to actually do right now. Here's the chapter that the previous 10 chapters have been building toward: the specific, actionable, prioritized preparation framework for the individual investor and household that wants to position for the range of outcomes the economic environment described in this video might produce. Let's be clear about the framework's design philosophy before describing its specific components. It is not designed for the single worst-case scenario. The Strait of Hormuz closure combined with a U.S. fiscal crisis, combined with a market crash, combined with mass AI unemployment. Designing a portfolio for that scenario would produce a concentration of gold, canned goods, and offshore accounts that would be catastrophically wrong in the base case scenario where most of the risks described in this video don't materialize in their most extreme forms. It is designed for a portfolio of outcomes, some of which are better than current conditions, some of which are significantly worse, and positioned to produce acceptable outcomes across that range, rather than optimal outcomes in any single scenario. Priority 1. The Emergency Fund, the non-negotiable foundation. Here's the first and most important preparation step, the one that provides protection against the widest range of adverse scenarios with the most certainty and the most immediacy, and the one that most people either don't have adequately funded or don't have at all. The emergency fund in the current economic environment needs to be larger than the conventional 3 to 6 month recommendation, specifically because the economic scenarios described in this video include employment disruption from AI-driven displacement and economic slowdown, which can produce longer unemployment spells than the 3 months that the minimum recommendation was designed to cover. The appropriate emergency fund for the current environment is 6 to 12 months of essential living expenses, not total monthly spending, but the specific essential expenses that cannot be eliminated in an income disruption: housing, utilities, food, transportation, insurance, and minimum debt payments. This fund should be held in a high-yield savings account, currently yielding 4% to 5% at online banks, that is accessible without penalty, and that is separate from both the investment portfolio and the checking account used for daily spending. The specific sizing guidance for households with employment in AI-exposed industries, technology, finance, legal services, content creation, customer service. The 12-month end of the range is appropriate. For households with more stable employment in less AI-disrupted sectors, skilled trades, healthcare, education, government, the 6-month end of the range is adequate. For households with significant fixed financial obligations, large mortgage, auto loans, personal loans, the larger fund is appropriate because the monthly fixed expense base is higher and harder to compress in an emergency. Priority 2. Debt reduction. The guaranteed return in an uncertain world. Here's the second preparation priority, the specific debt management action that provides the highest guaranteed return available in any economic environment, regardless of market conditions, geopolitical developments, or the specific scenario that ultimately materializes. High-interest consumer debt, credit card balances at 20% to 22%, personal loans at 15% to 18%, buy now, pay later balances at elevated rates, should be eliminated as the highest priority financial action after the emergency fund is established. The guaranteed return on paying off a 22% credit card balance is 22%. Risk-free, inflation-adjusted, certain. No investment strategy available to ordinary investors produces a comparable guaranteed return. The debt elimination sequence for households carrying multiple debt types, the highest interest debt first, regardless of balance size, the debt avalanche approach that maximizes the mathematical return on debt elimination. For households carrying a mix of credit card debt at 22%, auto loans at 8%, and student loans at 6%, the credit card is eliminated first, then the auto loan, then the student loan, with minimum payments maintained on all debts while every available additional dollar goes toward the highest rate balance. The mortgage exception, the primary residence mortgage, particularly for households with mortgages at the sub-4% rates of the 2020 to 2021 period, should not be aggressively prepaid in an environment where high-yield savings accounts and investment alternatives offer higher expected returns. The 3.5% mortgage rate is below the current high-yield savings rate, let alone the expected investment return, making prepayment of low-rate mortgage debt the specific debt elimination action with the lowest return relative to the alternative use of the capital. Priority 3. Income diversification, building the second engine before you need it. Here's the third preparation priority, the one that addresses the specific AI disruption risk that is more immediately threatening to more people's financial security than any of the geopolitical or market risks described in this video: the deliberate development of income sources that are not solely dependent on the single employment relationship that most people depend on. The specific income diversification actions that are most accessible and most relevant to the current environment, skills that are AI-resistant or AI-complementary. The development of skills that AI cannot easily replicate or that make the human practitioner more effective with AI tools produces the most durable income protection in the AI disruption environment. Specific skills, physical world capabilities that require presence and dexterity, skilled trades, healthcare delivery, construction, plumbing, electrical work, relationship-intensive professional services where trust and human judgment are the primary product, executive coaching, complex negotiation, crisis management, therapeutic services, AI integration capability, the specific skill of implementing and optimizing AI systems in business contexts, which is the professional skill most immediately valuable in an AI-enabled economy. Side income development before it's necessary, The freelance consulting, the content platform, the small business, the professional service offering outside the employment relationship, these income sources are most effectively built during periods of employment stability, when the startup costs and the initial low revenue don't create financial stress. The side income that takes 12 to 18 months to reach meaningful scale should be started now, while primary employment income provides the financial cushion to absorb the startup period. Passive income asset building, the rental property, the dividend-paying investment portfolio, the royalty stream, income sources that continue generating revenue regardless of the investor's active time participation, are specifically valuable in an environment where active employment income is subject to the AI disruption risk. Building these passive income sources is a long-term process, but the process needs to start at a specific moment, and the specific moment that produces the best long-term outcome is always the earliest available one. Priority 4. Portfolio positioning for multiple scenarios. Here's the specific investment portfolio positioning that is most consistent. With the range of economic outcomes described in this video, the allocation that provides meaningful participation in continued positive scenarios while providing specific protection against the downside scenarios that the risk landscape makes meaningfully more probable than historical base rates. Maintain equity exposure but reduce concentration. The risk of the equity market concentration in 7 technology stocks, described in Chapter 6, is specific and addressable through the equal weight index fund alternatives. The Invesco S&P 500 Equal Weight ETF RSP provides S&P 500 exposure with significantly lower concentration in the mega-cap technology names than the market cap weighted alternatives. International diversification, or through low-cost international index funds, provides geographic diversification against the specific U.S. fiscal and dollar reserve risks described in Chapter 2. Add inflation protection. TIPS, Treasury Inflation Protected Securities, provide explicit inflation protection through the indexing of principal to the consumer price index. A meaningful allocation, 10% to 20% of the fixed income portion of the portfolio, in short duration TIPS provides specific protection against the inflation scenarios described in Chapter 3 without the interest rate sensitivity of long duration TIPS. Real assets, through commodity index funds and REITs, provide additional inflation protection through the direct price linkage of their returns to the price level. Add commodity exposure, a 5% to 10% allocation to a diversified commodity fund, PDBC, or a similar instrument, provides specific protection against the oil price spike scenarios described in Chapter 1 and the agricultural price spike scenarios described in Chapter 9. The commodity allocation is a specific hedge against the geopolitical risks that the rest of the portfolio is most exposed to. Maintain cash at higher than historical levels, the high-yield savings account or short-term treasury bill allocation that provides both the liquidity of the opportunity fund, capital available to deploy at attractive prices during market dislocations, and the specific income of the current 4% to 5% yield environment. The opportunity fund is not dead money in the current environment. It is generating meaningful income while providing the optionality to deploy at better valuations if the downside scenarios materialize. Modest gold allocation, 3% to 7% of the portfolio in physical gold through a low-cost ETF, GLD or IAU, provides specific protection against the tail risk scenarios of dollar reserve erosion, fiscal crisis, and the geopolitical situations where gold's role as the universal store of value that cannot be sanctioned or frozen is most relevant. Gold is not an investment with expected positive real returns in the base case. It is insurance against the scenarios where conventional financial assets are most vulnerable. Priority 5. Career and human capital protection. Here's the preparation priority that financial analysis most consistently underweights: the specific investment in human capital that makes the individual more valuable, more adaptable, and more financially resilient in the economic environment described in this video. The AI transition is the most immediate and most personally threatening of the economic developments this video describes for most people in the professional class. The preparation for AI disruption is not primarily a financial portfolio question. It is a career strategy question that requires honest self-assessment of where in the AI disruption versus AI complementarity spectrum the current job function sits. The assessment framework is the primary value you provide to your employer the synthesis and application of existing information to standard problems? If yes, the AI disruption risk is high, and the career adaptation timeline is urgent. Is the primary value you provide judgment, relationship management, physical presence, creative originality, or the navigation of genuinely novel situations without established frameworks? If yes, the AI disruption risk is lower and the timeline is less urgent. The career protection investment, the deliberate development of the skills that are most complementary to AI, specifically the skills that make a human worker more effective when working with AI tools rather than competing against them. Learning to use AI tools effectively, developing the domain expertise that allows you to evaluate AI outputs critically rather than accepting them uncritically, cultivating the relationship and trust-based dimensions of your professional role that AI cannot replicate. These investments are both the career protection against the AI disruption and the income premium that AI complementary skills command in the current employment market. Chapter 12, The Psychological Preparation, How to Think About Uncertainty Without Losing Your Mind. Here's the chapter that addresses the dimension of preparation that financial analysis consistently omits: the psychological and cognitive preparation for an extended period of economic uncertainty that will produce the specific cognitive and emotional challenges that most people are least equipped to handle. Because here's the honest truth about economic uncertainty of the kind and duration described in this video. The biggest financial mistakes in uncertain economic periods are not made because of poor investment strategy. They are made because of poor decision-making under the emotional stress that uncertainty produces. The panic selling at the bottom of market declines, the defensive cash hoarding that misses recoveries, the paralysis that prevents action when action is required, and the anxiety-driven decision-making that optimizes for the elimination of present uncertainty rather than for the best expected long-term outcome. The uncertainty tolerance architecture. Here's the specific psychological infrastructure that produces the most resilient decision-making under the economic uncertainty described in this video, the cognitive and emotional framework that allows clear thinking when the news environment is producing maximum anxiety. The first component is the scenario acceptance practice, the deliberate, explicit acceptance that bad scenarios are possible rather than the implicit assumption that they are theoretical. The investor who has explicitly accepted that a 30% market decline is possible, not just intellectually acknowledged it, but emotionally processed it and decided in advance how they will respond, is dramatically better positioned to execute the response without panic when the decline actually arrives than the investor who has avoided thinking about the downside scenario because it is uncomfortable. The pre-committed response protocol, the specific written decision framework that specifies the response to each scenario before it arrives. If the market declines 20%, I will increase contributions by X%. If employment is disrupted, I will execute Y specific actions in Z specific sequence. If geopolitical escalation produces an energy price spike, I will implement W specific household adjustments. The pre-committed protocol converts crisis decision-making, which is dominated by fear, loss aversion, and cognitive shortcuts, into protocol execution, which is dominated by the rational advanced planning that produced the protocol. The information diet for economic uncertainty. Here's the specific information management practice that most improves decision quality during periods of economic uncertainty, the deliberate curation of the information consumed about the economic environment to maximize signal and minimize the noise that drives the anxiety-based decision-making that produces the worst outcomes. The problem with most economic news consumption during uncertain periods, the information environment is optimized to maximize engagement through the amplification of alarming information, the presentation of uncertain outcomes as more certain than they are, and the continuous delivery of new alarming information at a rate that prevents the cognitive processing that converts information into understanding. The investor who consumes economic news continuously during a period of elevated uncertainty is not making better informed decisions. They are making more anxious decisions based on more information that they have had less time to process. The specific information diet for economic uncertainty: consume high-quality, long-form analysis at lower frequency rather than continuous real-time news at maximum frequency. Set specific, limited windows for economic news consumption rather than maintaining continuous awareness. Distinguish between information that changes the decision, genuinely new developments that require updated analysis, and information that is new but doesn't change the decision, the continuous flow of market commentary, political developments, and geopolitical updates that produce anxiety without improving the decision framework. The quality threshold: ask whether the information source has been reliably accurate over time, whether it distinguishes clearly between what is known and what is speculated, and whether it provides the analytical depth that converts events into understanding rather than the immediate alarm that converts events into anxiety. The sources that meet this threshold are fewer and slower than the real-time information ecosystem, which is their specific advantage. The agency restoration practice. Here's the specific psychological intervention that most effectively addresses the specific anxiety that large-scale economic uncertainty produces: the restoration of the sense of agency that uncertainty erodes. The economic risks described in this video are large, complex, and significantly outside any individual's control. The geopolitical decisions that determine whether the Strait of Hormuz is disrupted are made by governments, not by individual investors. The Federal Reserve's policy decisions that determine the interest rate environment are made by committees, not by individual borrowers. The AI investment decisions that determine the pace of job market disruption are made by technology companies, not by individual workers. The psychological experience of facing large risks that are outside your control, without the specific focus on the things within your control, is the anxiety that produces the worst decision-making. The restoration of agency comes from the deliberate focus on the specific actions within your control: the emergency fund that you can build, the debt that you can eliminate, the skill that you can develop, the income stream that you can diversify, and the explicit acceptance that the things outside your control are things you will respond to rather than prevent. The agency restoration practice is the specific cognitive shift from "how do I prevent the bad scenarios?", which is impossible, to "how do I prepare to navigate the bad scenarios?", which is entirely within your control. The preparation framework of Chapter 11 is the specific content of this cognitive shift. The psychological shift is what makes the preparation framework feel empowering rather than futile. Chapter 13: The People Who Saw It Coming and What They Did About It. Here's the chapter that makes everything in this video concrete through the specific documented stories of people who identified economic disruption before it arrived, prepared appropriately, and navigated the disruption in ways that were dramatically less painful, and in some cases genuinely profitable, than the experience of the people around them who were caught unprepared. These are not stories about people who predicted the exact timing and magnitude of specific economic events. Nobody does that reliably. These are stories about people who correctly identified the general direction of risk, prepared for a range of adverse outcomes, and arrived at the disruption with the specific financial infrastructure that made the disruption manageable rather than catastrophic. The historical precedents matter because they establish that preparation works, that the specific behaviors described in Chapter 11 are not theoretical constructs but documented practices that have produced real financial resilience in real people facing real economic disruptions comparable to the ones described in this video. The 2008 financial crisis. The people who saw the mortgage bubble. Here's the most extensively documented case of economic disruption prediction and preparation in recent financial history. The 2008 financial crisis and the specific individuals and institutions who correctly identified the housing bubble understood the specific mechanism through which it would produce a financial crisis and positioned themselves accordingly. The story of Michael Burry, the hedge fund manager whose short position against mortgage-backed securities was documented in Michael Lewis's The Big Short, is the most famous individual case. But Burry was not alone, and the less famous cases are more instructive for ordinary investors because they didn't involve exotic financial instruments or institutional hedge fund resources. The ordinary investors who navigated 2008 best shared specific characteristics that had nothing to do with sophisticated financial analysis. They had not over-leveraged their housing purchases during the bubble years. They had bought homes they could genuinely afford at conservative loan-to-value ratios rather than the maximum the mortgage system would provide. They had maintained emergency funds large enough to survive the employment disruption of the recession. which averaged 18 months for displaced workers during the 2008 to 2010 period, they had investment portfolios diversified enough that the equity market decline, while painful, did not permanently destroy their financial position. They had not taken the specific actions that produced the most catastrophic outcomes for unprepared households. They had not taken cash-out refinancing on their homes to fund lifestyle spending, leaving themselves underwater when prices declined. They had not concentrated their investment portfolios in financial sector stocks, the specific sector that declined most dramatically. They had not carried credit card balances that became unserviceable when employment was disrupted. The preparation actions that protected them were not sophisticated or complex. Emergency fund, reasonable debt levels, diversified investment portfolio, stable employment or income diversification. The fundamentals that this video's preparation framework describes are the same fundamentals that made the 2008 crisis survivable and even opportunistic for the people who had followed them. The 1970s stagflation, the investors who protected purchasing power. Here's the historical precedent most directly relevant to the current economic environment: the 1970s stagflation period that combined elevated inflation with economic stagnation in ways that most closely resemble the specific risk combination that the current environment carries. The 1970s stagflation was produced by a specific combination of factors: the oil price shock of the 1973 OPEC embargo, the fiscal deficit spending of the Vietnam War era, the breakdown of the Bretton Woods fixed exchange rate system, and the loose monetary policy that the Federal Reserve maintained too long before aggressively tightening. The resulting combination, double-digit inflation alongside negative real GDP growth, was devastating for the conventional investment portfolios of the era. The investors, who preserved and in some cases grew their purchasing power during the stagflation decade, shared specific portfolio characteristics. They owned real assets, real estate, commodities, precious metals, energy production that appreciated in nominal terms as inflation eroded the purchasing power of cash and bonds. They held short-duration debt, treasury bills rather than long-term bonds, that matured and was reinvested at higher rates rather than being locked into the low rates of the pre-inflation era. They maintained meaningful energy exposure. In a period of dramatic energy price increases, the energy sector was the specific investment that outperformed most dramatically. The conventional investor of the 1970s, heavily concentrated in stocks and long-term bonds, both of which produced deeply negative real returns during the stagflation period, experienced a lost decade of real wealth accumulation that required the extraordinary bull market of the 1980s and 1990s to recover from. The investor with the real asset tilt described above preserved purchasing power through the decade and participated fully in the subsequent recovery. The current relevance, the specific portfolio adjustments recommended in Chapter 11, the TIPS allocation, the commodity exposure, the real asset tilt, the reduction of long-duration bond exposure, are the contemporary versions of the portfolio characteristics that protected purchasing power in the 1970s stagflation environment, the COVID economic disruption, the households that absorbed the shock. Here's the most recent and most personally familiar economic disruption, the COVID-19 pandemic economic shock of 2020, and the specific household financial characteristics that determined whether the disruption was survivable or catastrophic. The COVID economic shock was dramatic in its speed and its specificity. The employment disruption was concentrated in specific sectors: hospitality, retail, entertainment, travel, while other sectors experienced minimal disruption or even growth. The households in the affected sectors experienced sudden, complete income disruption. The financial outcome for individual households depended almost entirely on the specific financial characteristics they had before the disruption arrived. The households that navigated the COVID disruption with the least permanent financial damage shared the preparation characteristics that this video has described as appropriate for the current environment. The emergency fund covered the period between income disruption and recovery, which for many hospitality and retail workers was 4 to 8 months. The modest debt load meant monthly financial obligations could be maintained from emergency savings rather than producing default and credit score damage. The income diversification, the side income, the spouse's employment in a non-disrupted sector meant the household income disruption was partial rather than total. The households that experienced the most permanent financial damage from COVID shared the opposite characteristics. No emergency fund, requiring immediate credit card borrowing to cover basic expenses. High pre-existing debt levels that became unserviceable within weeks of income disruption. Single income dependency in a COVID-disrupted sector. The financial characteristics that made the COVID shock catastrophic are the same characteristics that make the economic disruptions described in this video catastrophic, and they are the same characteristics that the preparation framework of Chapter 11 addresses. The lesson from every disruption, what the prepared have in common. Here's the synthesis across all the historical disruptions described in this chapter, the specific common characteristics of the people who navigated each disruption with the least permanent financial damage. They had cash reserves that covered the income disruption period without requiring asset liquidation at distressed prices. They had debt levels modest enough that monthly obligations could be maintained through the disruption without default. They had income diversification broad enough that a single economic event couldn't eliminate all income simultaneously. They had investment portfolios diversified enough that the specific asset class most affected by the disruption didn't constitute their entire financial position. And they had maintained the behavioral discipline to not panic sell during the most alarming period of the disruption, holding through the decline and participating in the recovery that followed. None of these characteristics require genius. None require sophisticated financial products or complex strategies. They require the specific, unglamorous, consistently maintained financial behaviors that are easy to describe, easy to understand, and difficult to sustain because they require prioritizing future resilience over present consumption. The people who were prepared for previous disruptions were not the people who predicted them most accurately. They were the people who maintained the financial disciplines that made them prepared for any disruption, and who therefore found themselves prepared for the specific disruption that arrived. Chapter 14. The opportunity within the crisis. What economic disruption creates for the prepared. Here's the final chapter before the conclusion. The one that shifts from the risk analysis and the preparation framework to the specific observation that economic disruption, for the people who have done the preparation described in this video, is not purely a defensive challenge to survive. It is also a specific set of opportunities that the disruption creates and that the unprepared cannot access precisely because their financial position is too stressed to allow the opportunistic action that the disruption makes available. This chapter is not optimism bias, dressed as financial analysis. It is the specific, historically documented observation that every significant economic disruption produces specific and genuine opportunities for people with the financial infrastructure to access them, and that the people who access those opportunities are almost universally the people who were prepared rather than the people who were most analytically correct about the disruption's timing and magnitude. The asset purchase opportunity. Why crises are when fortunes are made. Here's the most consistently documented opportunity that economic disruption produces, the specific window of time during which genuinely valuable assets are available at prices significantly below their intrinsic value because the holders of those assets are being forced to sell by financial stress, rather than choosing to sell based on the asset's value. Every significant market decline, the 2000 dot-com crash, the 2008 financial crisis, the 2020 COVID crash, produced a specific period during which the investors with available capital could purchase high-quality assets at prices that were subsequently recognized as extraordinarily attractive. The S&P 500 at its March 2009 low was available at a CAPE ratio of approximately 13, one of the lowest valuations in modern history, representing a genuine multi-decade buying opportunity that rewarded patient investors with extraordinary subsequent returns. The March 2020 COVID low represented a 34% decline from the February peak that recovered completely within approximately 5 months, producing extraordinary returns for the investors who held through the decline and added at the lows. The specific characteristic that allowed those investors to capture the opportunity rather than being forced to participate in the forced selling, liquidity, cash, the emergency fund plus the opportunity fund described in Chapter 11, the investor with the financial infrastructure that didn't require selling. Assets at the distressed prices had the specific ability to be the buyer rather than the seller, to purchase the assets that the financially stressed investors were liquidating at prices determined by their need to sell rather than by the asset's underlying value. The current environment's specific opportunity implication, the economic scenarios described in this video, the market decline from elevated valuations, the real estate correction from affordability-induced demand reduction, the business availability from AI-disrupted industries where current owners want to exit, each create the specific buying opportunities that the liquidity-equipped investor can access. The emergency fund and opportunity fund described in Chapter 11 are not just defensive preparations. They are the specific financial resources that make the opportunistic action possible when the disruption creates the opportunity. The career opportunity, the disrupted industry as the entry point. Here's the second category of opportunity that economic disruption creates, the specific career and business opportunities that emerge when established industries are disrupted and the incumbents are defending existing positions rather than building new ones. Every major economic and technological disruption of the past century has created the specific conditions that produce the next generation of dominant businesses. The 2008 financial crisis produced the regulatory and competitive vacuum that allowed fintech companies to build the digital financial infrastructure that the incumbent banks were too stressed and too regulatory focused to build. The early 1970s stagflation and energy crisis produced the energy efficiency innovation that created new industries and new employment. The 2000 dot-com crash cleared the speculative excess from the internet economy and allowed the genuinely productive internet businesses, Google, Amazon, PayPal, to grow without the competitive distraction of the hundreds of cash-burning pretenders that the bubble had funded. The AI disruption described in Chapter 4 is already producing the specific career opportunities that disruption creates, the demand for AI implementation specialists, the demand for domain experts who can evaluate and improve AI outputs, the demand for the human judgment and relationship skills that AI complements rather than replaces. The workers who treat the AI disruption as the signal to develop the AI complementary skills described in Chapter 11 are positioning themselves for the career opportunities that the disruption creates rather than defending against the displacement it produces. The real estate opportunity. When affordability breaks, investors with capital win. Here's the third category of opportunity that the specific disruptions described in this video are creating. The real estate opportunity that the affordability collapse and the commercial real estate crisis are producing for investors with the liquidity to act. The residential real estate market that has become unaffordable for most first-time buyers has not become unattractive for investors who are purchasing with cash or with investment-appropriate financing, rather than with the 3% down payment mortgages that consumer homebuyers use. The rental demand that is produced by the affordability-driven exclusion of potential first-time buyers from homeownership is the specific demand that supports rental property investment, and the affordability crisis that is preventing household formation through home ownership is simultaneously producing the rental demand that makes residential rental investment attractive. The commercial real estate distress described in Chapter 7, the office buildings that are being foreclosed on at a fraction of their previous values, the retail properties that are being sold by financially stressed owners at distressed prices is producing the specific buying opportunity in commercial real estate that the 2009 to 2012 residential distress produced for the investors who were prepared to act. The specific opportunity is not available to the investor who needs to sell assets to fund the purchase, who is forced to be a seller at the moment that the distressed market is producing buyers' prices. It is available to the investor who has maintained the liquidity, the emergency fund, and the opportunity fund that makes the purchase possible without requiring simultaneous forced selling. The business acquisition opportunity when disrupted owners want to exit. Here's the fourth category of opportunity that the economic environment described in this video is creating: the small business acquisition opportunity that AI disruption, demographic change, and economic uncertainty are producing as the owners of established, profitable businesses increasingly want to exit. The demographic reality of the small business ownership market, the baby boomer generation, the largest cohort of small business owners in U.S. history, is approaching or in retirement age simultaneously. The specific combination of retirement motivation, AI disruption anxiety, and economic uncertainty is producing the highest volume of small business sellers in decades. Businesses that are profitable, established, and priced at multiples that reflect the seller's desire to exit rather than the business's intrinsic earning capacity. The specific acquisition opportunity. The plumbing company whose 67-year-old founder wants to retire and has no succession plan. The accounting practice whose principal wants to exit before AI further commoditizes the services. The specialized manufacturing business whose owner is uncertain about the economic outlook and prefers liquidity to continued operation. Each of these businesses is generating cash flow, has established customer relationships, and is available at seller-motivated pricing that produces the asymmetric return profiles that the Chapter 8 investment framework described. The investor who has maintained the financial infrastructure, the liquidity, the debt capacity, the professional relationships with business brokers and SBA lenders that makes these acquisitions accessible is positioned for the specific buying opportunity that the disrupted business sale market is creating. The investor who is fully deployed in a stressed financial position has no capacity to access the opportunity, regardless of how attractive the pricing is. The mindset of the crisis investor. Calm when others are panicking. Here's the final and most important dimension of the crisis opportunity: the specific psychological posture that makes the opportunistic action possible when the economic disruption is producing maximum fear and maximum urgency to act defensively rather than offensively. The investor who has done the preparation described in Chapter 11 has a specific psychological advantage in the crisis moment that goes beyond the financial advantage of having capital available. They have the psychological security of knowing their financial foundation is intact. The emergency fund is fully funded. The debt is manageable. The income is diversified. The portfolio is positioned for a range of outcomes. The specific financial anxiety that drives the worst decisions, the panic selling, the defensive cash hoarding, the paralysis, is significantly reduced by the knowledge that the specific financial vulnerabilities that the crisis would exploit have been addressed. This psychological security is what makes the opportunistic action possible. The investor who is lying awake at night worrying about whether they can make next month's mortgage payment if the economy deteriorates further cannot be the calm buyer of distressed assets at the market bottom. The investor whose financial foundation is solid enough that the deterioration produces concern but not existential. Financial threat can be the buyer that the distressed market needs and can capture the returns that the distressed pricing makes available. The crisis opportunity is not available to everyone. It is specifically available to the people who have done the preparation. The preparation is not only about surviving the crisis, it is about arriving at the crisis in the specific financial position that converts the crisis from a threat to be survived into an opportunity to be captured. This is the final and most important argument for the preparation framework of Chapter 11. Not just that it reduces the pain of the bad scenarios, but that it is the specific prerequisite for the opportunity that the bad scenarios create. The unprepared are the sellers in a crisis. The prepared are the buyers. The buyers are the ones who look back on the crisis and call it the best financial decision of their lives. Prepare to be a buyer. Conclusion. Let's bring the complete picture into focus. Honestly, specifically, and without the false comfort of either denying the risks or predicting their inevitable materialization. The economic environment you are navigating is genuinely complex and genuinely risky. The risks are not imaginary, not overblown, and not the product of YouTube anxiety optimization. They are specific, mechanistically grounded, historically precedented risks that are operating simultaneously in a financial and geopolitical environment that is less resilient to their interaction than the environments in which previous generations of these risks were managed. The Middle Eastern situation has a specific, direct transmission channel to the global energy economy through the Strait of Hormuz that makes it the highest immediacy economic risk in the current environment. The debt supercycle has produced a financial system under structural stress from the interaction of unprecedented debt levels with interest rates that are painful for every over-leveraged borrower simultaneously. The inflation that was supposed to resolve cleanly has proven persistent in the ways that are most damaging to household purchasing power and most difficult for monetary policy to address. The AI transition is disrupting the employment market for a specific and large category of professional workers faster than the retraining ecosystem can absorb the displacement. The geopolitical fracture is producing the structural inflation premium and supply chain inefficiency that will raise prices for a decade or more. The market valuations that are supposed to be the financial cushion against these risks are stretched against a scenario of optimism that the risk landscape does not fully support. And yet, the end of the world has been predicted in every era of recorded history and has not arrived in any of them. The economic disruptions that seemed terminal from the inside of them, the 1970s stagflation, the 1987 Black Monday crash, the 1997 Asian financial crisis, the 2000 dot-com collapse, the 2008 financial crisis, the 2020 pandemic economic shock, produced genuine pain and genuine losses, and in every case were followed by recovery and by the continuation of the long arc of human productive capacity that bends toward growth. This is not a guarantee that the current risks will resolve as previous risks have. It is the base rate, the specific historical frequency with which large, serious, legitimate economic risks have resolved without permanent civilization-level damage, that should inform the probability weighting of different scenarios rather than the vivid, present-tense alarm that the current moment produces. The preparation framework this video has described is not designed for the end of the world. It is designed for a range of genuinely bad outcomes. Outcomes significantly worse than the current base case, but significantly less bad than the catastrophic scenarios that drive clicks and sell subscriptions. The emergency fund, the debt reduction, the income diversification, the portfolio positioning, the career investment, the psychological infrastructure. Each of these preparations has positive expected value across a range of economic outcomes, including the most likely outcome, which is somewhere between the comfortable continuation of current conditions and the worst case. The people who will look back on this period with the least regret are not the ones who predicted the specific scenario that materialized. They are the ones who prepared for a range of scenarios, maintained the specific disciplines of financial resilience through the uncertain period, and arrived at whatever outcome the economic environment produced with enough financial foundation to absorb the bad ones and enough positioned exposure to participate in the good ones. Prepare for range, not for prediction. Stay invested, not in any specific scenario, in your own financial resilience. And the next time someone tells you the economy is fine and there's nothing to worry about, remember that the people who got destroyed by every economic crisis in history were not the ones who were worried. They were the ones who weren't. You are now in the category of people who are paying attention. Make sure you are also in the category of people who prepared.